All right, last part is a special deduction that small businesses are entitled to. There's another newish, 2017. This with that tax law. This is another a deduction that was just instituted starting in 2017. It's called the QBI, Qualified Business Income Deduction. So it's a deduction that shows up directly on the 1040. It goes right under, you've probably seen it. It goes the line right under the standard deduction. There are two lines there for deductions. This is the one that's right underneath it. So you only get this deduction if you have qualified business income. So qualified business income comes from business income from sole proprietorship, so the Schedule C that we've been talking about, and flow-through entities, partnerships, LLCs, S corporations, trusts, and estates. We're going to talk a little bit more about flow-through entities in Chapter 8. The purpose of this, it's a 20% deduction. So you multiply whatever that qualified business income is, you multiply it by 20%, and then you get to subtract that from your total income before you calculate income tax. It does not reduce self-employment tax. Has no effect on self-employment tax. So that calculation we just did with self-employment tax, we do this calculation completely separately, okay? But it reduces taxable income. So, which obviously then reduces your total tax and your tax liability. So what they did with, in 2017, they reduced the corporate tax rate. The highest corporate tax rate used to be 35%. It's now 21%. That was a big reduction. But when it was first initially introduced, it was only for essentially what are called C corporations, a particular type of corporation under the tax law. C corporations, I mean, they're businesses that, they're usually bigger businesses, and they're businesses that offer stock to a variety of individuals. There's no limitations on who can purchase their stock, but we normally think of them as larger companies. So they offered this, they introduced this lower tax rate from 35%, which was the highest tax rate. Actually, the lowest corporate tax rate was 15%. So for some C corporations, their tax rates actually went up from 15 to 21%. But for a lot of the big guys, their tax rates went down from 35% to 21%. But they didn't offer anything initially to the smaller businesses, to these partnerships, to S corporations, to sole proprietorships. And actually, the vast majority of companies in this country are these smaller businesses. They're not organized as C corporations. They have a different organizational structure. So what they did was they came up with this special deduction for smaller businesses, for partnerships, LLCs, S corps, and for Schedule C sole proprietorships, this 20% qualified business income deduction. What it is, so it is a 20% deduction from AGI, so it comes after AGI, does not affect the AGI limitation. So anything that requires you to know AGI, this doesn't reduce it any further. The deduction is shown on line 13 of Form 1040. So like I said, right below the standard deduction. It's calculated by multiplying line 31 of Schedule C. So that Schedule C, line 31 that we used on the Schedule SE that got transferred there, this is the same number we use, minus the deductible part of self-employment tax and deductible health insurance. So if we have self-employed health, let's say our net income, so line 31, Schedule C, net income is $200,000. But we also, on our Schedule 1, had adjustments for 1/2 self-employment tax. Let's just say that was, I'm just going to make up a number. It's not going to be related to this. 15,300. Well, actually, it's not going to be that. Well, let's just say that's what it is. 1/2 of our self-employment tax. And then we had self-employed health insurance that we paid of 20,000. So 700, what is that? 35, so 4, 6, 164,700. So that is line 31 minus the deductible portion of self-employment tax minus the deductible portion of health insurance. We'll take this, we'll multiply it by 20%. So whatever that is, 164,700. 32,940. This, what we're going to do is we're going to compare this to 20% of our taxable income before QBI. So if because we may have other types of income, right? We may have W-2 income, we may have capital gains income, we may have interest, dividends, all that stuff. So we're going to take our taxable income, multiply that by 20%, and we're going to take whichever one is less of those two numbers. So if we had taxable income of, let's say it was 185,000, we're going to take 20% of that, which is, let me get a number that I can actually multiply in my head easier. Let's say our taxable income was 200,000. So this was our net income from self-employment, but we had other types of income. Actually, that doesn't really make sense. Let's make this 25 or 250,000. So 50,000. We're going to compare this to this, and we're going to take the lesser of those two. That's our qualified business income deduction. So in addition to, if you remember on the schedule, I don't know if they have it here. They give us one here? No. On the 1040, I don't think they give us a 1040 up here. We have I can't remember which line it is. So I think line 11 is our AGI, and then we subtract, or line 12 is our AGI, one of the two, and then we subtract our standard deduction or itemized deductions, and then we subtract this before we get to what our taxable income is. That line 15. And then so this has the potential to be a huge deduction. Now there are limits to it as well. So that's the calculation for it, but there are also limits to it. The business income has to be from what they call a specified business, includes service fields, or where the business income is generated from the reputation or skill of one or more of its employees. So here's some examples: health, law, accounting, consulting, athletics, brokerage services. So it has to be this specified business. It includes more than that, but these are just some examples of ones where, like, it can also be from the sales of items and that. It's limited when taxable income, so that taxable income from the whole return, exceeds $838,900 for married filing jointly. Between that and $483,900, so $100,000 range where it phases out, $191,950 up to $241,950 for all others. The deduction phases out, so that phase out like we did with the student loan interest. You don't have to do a phase out. You don't have to do anything with this. This is just FYI, by the way. You don't have to do this calculation. You will have to do this calculation, okay, with that tax return problem. These are the phase outs. So for higher income, even if you're in one of those specified businesses, if you have higher income, you're not going to get this deduction. It starts to phase out. Let's see. If taxpayers are above the threshold income limit, and they're not in one of those service fields, though, the taxpayer is subject to an additional W-2 wage limitation. Again, you do not have to do this calculation with your homework. This is just kind of an FYI. But like I said, you do have to do this calculation, and you have to do this comparison between the two with the tax return problem. Not going to do that one. Let's look at this one. Allison makes it $600,000 in QB. No, I don't want to do that because we're not going to. That's too complex. Allison makes $200,000 in QBI, qualified business income, from her Schedule C, net of her deductible self-employment tax. Her taxable income on her Form 1040 is $260,000. So her deduction is going to be $40,000, the lesser of 20% of her QBI, which is $40,000, or 20% of her taxable income less any capital gains. Okay, so she did not, so this was her taxable income before any capital gains, $260,000. You would take 20% of that, compare it to 20% of the $200,000, whichever's less of those two is what the QBI would be. If she makes $200,000, but her taxable income is $180,000, so taxable income could be less due to 4 AGI deductions for self-employment tax and self-employed health insurance, because remember, we've got to subtract those items here. Then the deduction would be, instead of it being 20% of that, it's going to be 20% of that taxable income, because that's the lesser number. So whichever is less of those two. That's the QBI. So, any questions on that? No?